to the Inspire Wealth podcast with Prof, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome to another episode of Inspire Wealth. I am your host, Prof M, and today I am so excited to be joined by Amanda and Matt. Amanda and Matt, welcome to the show.
Thank you for having us, Mallory. Appreciate it.
Excited to be here.
Yes. So I have met you guys. Well, I've met you from afar, I guess. And so I'm really excited to get your take on real estate, specifically tax, because those that know me know that I love talking about tax. So why don't we start off by you guys introducing yourselves, giving us a little bit of background about what you do, and then we're going to dive into it.
Great. Well, yeah, again, thank you for having us. Appreciate it. It's always fun to kind of get a chance to talk about our favorite topic, taxes and real estate. But we're both CPAs and real estate investors. We are married to each other. We've been doing this for 20 plus years. Our firm, Keystone CPA, specializes in working with real estate investors all over the country on proactive tax planning, kind of help them, save more of their hard-earned money and, use that money to reinvest in real estate. Obviously, is our favorite asset class, and kind of use those tax benefits to kind of keep building our wealth.
Yeah. And what I always tell people is we are CPAs by day and real estate investors by night. So, like many of you, we also invest in real estate ourselves, and always super happy to be, share knowledge, because I think not a lot of people know that you can actually control your taxes. It's not just something that has to happen to you. There are absolutely things you can do proactively to determine how much or how little taxes you pay.
Yeah, no, that's great advice. So let's start out with the people who maybe have W-2 jobs and they're looking to start building a portfolio. What would be something that you might suggest that they start if they're looking to be proactive in their tax planning? What might be something you would advise these people to right off the bat?
Well, I would say, once you start investing in real estate, you become a business owner in the eyes of the IRS. And so that shifts a lot of the possibilities of what you can actually write off. We all know that as a W-2 earner, there's very few deductions that we can take advantage of, 401k, health savings account. But as a real estate investor, now we open up the doors when it comes to business deductions. And so the key is taking a look at what are some of the things that we're spending money on already, and are there ways to legitimately turn those into business deductions?
Yeah, and another thing about investing in real estate specifically that's unlike investing in stocks and mutual funds. If somebody goes out and buys stock, pays $10,000 for pick a stock, whatever it is, right? You don't write that off right away. You don't actually write that off until you sell the stock down the road. But unlike rental real estate, where you can buy rental real estate and they actually let you take a write off for a part of the purchase price every year against your income from that property. So it's a way that you can make cash flow from the property, but also shelter it with what they call depreciation expense. And so there's ways that you can have cash in your pocket and not have to pay any taxes as a starting point. And then, looking at maximizing your other deductions too, there's kind of ways to also bring that down to zero, or maybe even create a paper loss on your tax return too.
Yeah, I think that's great advice. And I think, the power of depreciation is one of the best things that real estate has for it as far as an investment. So let's talk about the market today. So a lot of investors are somewhat hesitant to invest due to high interest rates and, maybe some uncertainty. So what kind of strategy have you been deploying when people might come to you and say, look, I still want to be proactive in my tax planning. I still want to be investing in real estate, but on paper, it doesn't pencil as far as cash flow is concerned. So what happens then?
It's really interesting. I'll say two things. One, it's about getting better at playing the game of real estate. In the past couple of years, it's like anybody can make money in real estate just with natural appreciation, low interest rates. But now it's just you have to be a little bit more intentional. So if you have you're analyzing a deal, and if it doesn't make sense as a long-term rental, well, maybe let's see if it pencils out as a midterm rental. There are a lot of families who are displaced due to natural disasters or different kinds of insurance claims or needing to travel for medical treatment. And so a lot of times that same exact property, if we rerun the numbers and it operates as a midterm rental or even like a short-term rental on an Airbnb, oftentimes what you'll find is now all of a sudden it does cash flow, even in light of the purchase price and the higher interest. The other thing I would say is there's a saying uh, to date the rate, marry the price, which means, in this type of market, what you can often do in a buyer's market is purchase it at a better price than you would have maybe a couple years ago. Yes, the interest rates are higher, but that's a temporary fact. And you can always make sure to refinance in the future when the interest rate goes down. So it's just being more intentional and having a different set of lens when you're looking at specific deals.
Yeah, the other thing I thought of was, speaking of interest rates, right? If you, yes, they're high when you're going with conventional financing and stuff, but a lot of our investor clients are looking for unconventional financing, right? They're looking at maybe the seller is going to provide a seller financing to me at a better rate than 6.75%. Maybe we have a lot of clients that use their retirement accounts to invest in real estate, and so one of their assets inside their retirement, maybe they're lending money to people who are buying rental real estate, and so if you can find friends, investors that have retirement accounts with money just idle sitting there, they can lend you at 4% or something. Maybe that pencils out versus using, a traditional bank.
So, speaking of retirement, because I think this is a good segue, let's talk about how people can utilize their retirement to invest in real estate and what some of those tax implications might look like, especially if it's something, because I guess most W 2 employees are going to have a 401k. And so, if they were to maybe add in a Roth IRA or a simple 401k if they do have a business, what are some things that you're seeing your clients doing as far as using that asset or class of money to buy real estate?
Yeah, we have a lot of clients who use retirement money for real estate. And you're right, most Americans have a pretty significant chunk of their net worth in accounts like 401ks and IRAs and Roth. So it's really important as part of tax planning to take a more holistic look at what are all the different cash and equities I can deploy when I am looking at real estate investment beyond just cash in the bank. So if you're someone who have 401k money from an old job, like you've left that employer, the majority of the time you can roll that money into a self-directed account. And once the money is in the self-directed account, then the retirement account can then use it for real estate investing. And I say retirement account because we're not saying Mallory is investing in, 123 Main Street. We're saying Mallory's IRA is investing in
Excuse me, it's Prof M.
a profit. Professor M is investing in the rental real estate. Um, and typically that's for most investors, this is the route we recommend because when you do that, there are no taxes or penalties associated with it. It's simply a matter of, no longer using this money in stock. I'm instead using it in real estate, which is very different than what some people will do, which is to liquidate the retirement account and then use it as cash to invest in real estate. And if you are someone who's considering doing that, make sure you talk to your CPA because there are definitely going to be tax consequences when you liquidate the retirement account. And if you're not of retirement age, there's also penalties associated as well.
Yeah, I think one of the things we talk to our clients about is just what is your retirement accounts investing in right now, and what's it earning, and what do you think it could earn if you put it into a self-directed account and kind of control that you're investing in this real estate or that deal or that deal. For a lot of our clients who obviously understand real estate, that's kind of their main asset class. They feel like they can get a better return kind of controlling it that way. There's definitely lots of rules and pitfalls and things that people would be aware of. It's not a do-it-yourself thing by any stretch of the imagination, but in the right scenario, self-directed investing, can make lots of sense.
So, describe to me if I have, let's say, $100,000 in a self directed IRA, and I wanted to go out and I wanted to buy a duplex. Now, if the duplex costs more than $100,000, what are some of my options?
Yeah, so in a situation like that, IRAs can get financing. It has to be what's considered non-recourse financing, meaning you're not signing a personal guarantee on it. But let's say in that example, your duplex costs $200,000 and you've got 100 grand in your IRA. So you're getting a loan of $100,000 to the IRA. In that situation, you've got some leverage there. So typically, obviously, when you use your retirement account like a regular IRA to invest in something, you're not paying any taxes right now. Everything's deferred until retirement age, right? When you pull the money out in 70, 75. Um, in a situation like this, to the extent that you make money on that deal, since you're using leverage or bank financing, and part of that money you make may be subject to taxes inside the IRA, but the portion that you put in, your $100,000, that portion is not subject to taxes. So I think that's a little kind of tidbit that a lot of people don't realize. They're like, hey, I'm investing in a retirement account. I don't have to pay tax right now. But even having said that, there's still lots of times that it still pencils out, right? Again, it goes back to, hey, what were you earning doing what you were doing before? Even if you have to pay a little taxes, you made some money over here inside your IRA. If your after tax rate of return is still better than it was before, then you're still coming out ahead for sure.
Yeah, definitely. I think one of the best strategies that real estate investors or business owners have are being able to pay their children. And so when you are talking to clients who are maybe using that benefit of transitioning income from their higher income bracket to their children's lower income bracket, and assuming that maybe they want their children to then deploy that money into an IRA. Are you seeing anybody then utilize the children's IRA to purchase real estate for them so that by the time they, maybe this is an alternative college savings plan or something along those lines? Are you seeing anything like that happen?
Yeah, for sure. But typically, practically speaking, these are generally when the kids are older. So yeah, we actually have a client who, they pay their kids every year. They write it off on their tax returns. The kids then fund their own retirement account. And then, over the stretch of several years, when the kids have enough money in their IRA for a down payment on a rental property, then yes, the concept is if they wanted to, then they could use that to invest in real estate. And it's really, really powerful because most of the time the kids aren't funding an IRA, they're funding a Roth IRA, which means that money is growing tax free. And if you think about, a child having accumulated all of this money, when by the time they're age 16, 17, 18, that is a long road ahead of tax-free growth that they could build their legacy on. We also have clients who, instead of putting money into like a 529 plan, the traditional tax saving route, to
Mm-hmm.
just then buy a rental property. Now, in that concept or in that scenario, the real estate is in the name of the parents, not in the name of the kids. So if the parents buying a property, let's say on a main street, and they're just saying, well, this property is going to be earmarked for Johnny, right? So in the future, when Johnny grows up, I'm going to use the cash flow accumulated. I'm going to use the equity to then pay for Johnny's college. So it's just, yeah, lots of different ways. If real estate is your vehicle, there are a lot of different tax advantage ways to use it for kids' education or also helping your kids to build wealth as well.
Yeah, I think that that's really applicable and something that people don't necessarily think about. They just kind of go after the 529 plans because that's kind of what they've been told to do. But I know for me, I have a 5 year old and I plan on having a property that is earmarked for her. And when she's 18, she gets to choose what she wants to do with it. If she wants to sell it and use proceeds to pay for school or whatever, that's going to be her choice. So
Yeah.
I like that. Now, speaking of other things happening in the market, so we've seen a lot of political changes, and we're now in a new political, let's say, realm that we experienced before and now has come back. And with that, the Trump administration had a lot of tax reform during their first administration back in 2017. And now a lot of those policies are coming to either to sunset clauses or phasing out. What do you guys think might happen as far as new legislation or things that real estate investors could potentially plan for under the new Trump administration?
Yeah, it's a great question and very timely, obviously, because just recently the House came out with their kind of version of this bill that's, still being negotiated as we speak and stuff. But it was, I think the initial, what I read was the initial thing went from like 28 pages to 400 pages. So there's a
Naturally.
lot of
Yeah.
stuff in there. And to your point, when tax changes came out in 2017, there was some stuff that kind of had been brought back to life, but there was some brand new stuff. And so I'm still, as a CPA, I'm expecting there's going to be some stuff in this new bill that has not even been talked about yet. It's brand new. Everyone's going to have to learn it. But some of the stuff that's, to your point, they are going to extend some of the things. They're talking about bringing back bonus depreciation. That was kind of, we had it at 100% for a while. It's been phasing out down to like 40% this year. There's talk that they're going to bring that back to 100%. The way it's currently written, if it gets signed as it's currently written, it would be 100% bonus depreciation for assets purchased after January 20th, 2025. I asked myself why that date's important, but I think that might be when he was inaugurated. That's
I
kind
think
of
so
what it
too.
what it came to my mind. But I was like, well, that's why are we making this hard? Like, let's just say January 1st. Like, this is crazy. But anyway, so yeah, I think they're gonna bring back bonus depreciation. There, some other potential changes. A lot of stuff on the individual side of things, like standard deductions and things like that. They're talking about extending opportunity zone investing again. So that might be a carrot, benefit for people in the right situations. Um,
I think what's really interesting for real estate investors, but also just business owners in general. In the past couple of years, we've had qualified business income deduction, where basically for many real estate folks, the first 20% of income is not taxed. So, simplest example, I make $100, the first $20 is not taxed at all. So, in the latest release of these proposals, they're wanting to increase that from 20% to 23%. So very, very interesting things like that said that's happening. Obviously no taxes on overtime and tips. And one of the jokes I said is, hey, for all the tenants, don't pay me rent anymore, pay me tips. I'm only accepting tips now. See how that goes. Really,
this isn't being recorded, right?
I don't think that is going to go well. I mean, they define sort of like, it's for restaurant industry and some of the services industries. I don't know that rent will fall underneath it, but I'm sure there's some lobbying that could go on for that still.
Yeah, I mean, maybe like late fees can be considered tips or something like that.
Right, right.
Cleaning
We could
fees.
be creative about this, right?
Yeah.
Um, so I agree. I think that especially bonus depreciation is likely to be extended, just given like the nature of how the Trump administration worked the first time around. So let's talk a little bit about opportunity zones, because that's not something that a lot of people understand or really get to know. So why don't you guys give me your 30,000 feet view of opportunity zones?
So historically, when you sell real estate, you can kind of 1031 exchange and defer the taxes down the road. But if you were to sell stocks, you can't 1031 exchange stocks, right? So opportunity zones sort of came out as a sort of a hybrid of those things where if you sold an asset and you had capital gains, whether it's stocks, real estate, business, or your home, if you have capital gains, you were able to take that money and reinvest it in opportunity zone funds. And if you did that, you were able to defer the capital gains taxes. Under current law, you can defer until 2026. So, for example, if I had capital gains this year, I invested that in the ozone fund, I can defer taxes for a 1 year term. And the other benefit of that is not only do I get to defer the taxes, but if I hold that new asset for at least 10 years, then I could have tax-free appreciation on that specific investment. So when it first came, I think we were very excited. We're like, oh my God, this is the best thing. Everyone's going to use it. We're going to become experts at ozone. But then what we realized is because so many of our clients are real estate, they still really defaulted to the 1031 exchange. And I think the reason for that is because 1031 exchange didn't have kind of that ticking time bomb of 2026. You can just continue to defer indefinitely into the future. So what we saw in practice was mostly the people who did apply the opportunity zone were people who sold non-real estate assets. So business, sale of businesses, sale of stocks specifically, clients who like exited stock or stock from their company that were sold, redeployed those into opportunity zone funds.
So I think what's happening, at least in the current kind of draft of legislation, is they're extending the ability to use the opportunity zone so you can sell assets and still there's going to be another period of time where you can get some future growth. What I was hoping obviously in there was that people who had previously used it and their taxes are coming due next year, we're going to get a deferral on that. Haven't seen that written in the law yet, but we'll keep our fingers crossed.
Yeah, I think that that's a good point to note that, if you do have real estate investments, investing in an opportunity zone doesn't necessarily fit the bill if you can then just use a 1031 exchange to defer your capital gains. And you can do that to like infinity. So if I am, let's say I'm a business owner and I'm looking to sell my business, I could take the proceeds of that business and then redeploy that into an opportunity zone asset within real estate. And as of right now, the only benefit of doing that investment would be that I would defer my capital gains taxes for 1 year until 2026, unless extended by legislation. Is that correct?
Yeah, that's correct. So it's actually not the proceeds, you can defer the gain.
The gains,
So
yes.
assuming when you sell your business, it's capital gains. It's 500,000 of capital gains. You can actually pick and choose how much. You don't have to defer the whole thing. You can say, "Well, I want to defer $100,000 of the gain. So I'll take 100,000, reinvest in opportunity zone fund." Now we always talk about real estate, right? So the fund owns real estate assets. But opportunity zone funds could actually be in different types of things too. Could just be in a business located in the O zone. But yeah, in our realm, it's mostly real
But
estate,
the
mostly
other the
multifamily.
other benefit too is that if you do hold on to that asset, a new replacement asset for 10 years, any appreciation you get in that asset can become tax free. So that's where in the right scenario it might make sense for people if they anticipate holding that asset for a long period of time. Um, but again, a lot of our clients there, they sometimes they look at a 3 to 5 year window for real estate, so that may not match what their goals are, right? But
Yeah. So that 1 year in our example, sold the business for 500,000, reinvested 100,000 into ozone. If that $100,000 investment ends up being $1 million in 10 years, I do get to have 900,000 of that growth to be completely tax free. So for a lot of people, that's sort of the not the cherry on top. That's sort of like the main reason why they do it too, right? The 1 year deferral, great, but I want 10 years tax free.
Yeah. Do you envision that the legislation might evaluate where they have defined opportunity zones, like in understanding like that maybe markets have shifted and maybe things, some areas may have been gentrified and some areas may have gone the opposite direction?
Yeah, I mean, it's interesting because I think the ozone is, the tax code is a nationwide, right? It's a federal tax law, but my understanding was in defining where the zones were, I don't know if that was like with the input of the state or, at the local level to determine
yeah, I wouldn't
what's
be
more
shocked if
important.
they kind of reevaluated that for sure because, or they look back and go, hey, we anticipated all this was going to happen over the last 8 to 10 years, and we maybe it happened in certain areas, it didn't happen in others, and they might kind of shift their focus or something like that for sure.
Yeah, it's very interesting, the way that opportunity zones have kind of been identified. And, most of the time they're using the census data as to defining exactly whether an area qualifies as being, I don't know if it's 150% poverty level or 125% poverty for that particular market. But where I'm located in State College, I'm in a college town, and our downtown area has been identified as an opportunity zone. And the reason behind the fact that it has been identified as an opportunity zone is because students live downtown. And so their
Poverty.
income qualifies as being under the poverty level, which is such like a default thing because if you look at assets and the value of assets within our town, the downtown region has the highest value of
Yeah,
assets.
yeah,
And
Yeah.
so it's funny, we have all these student housing complexes going up. Well, no wonder because the investors understand that it's also in an opportunity zone.
Yeah.
yeah. We had. I mean, we're in Southern California, and I haven't looked in a few years, but there was beach towns that
Mhm.
have the highest value of real estate in Southern California that were listed in these opportunity zones, and it's the
Mhm.
same thing. You kind of scratch your head like, so you don't know who were the legislators pushing that envelope, or why are you wanting to invest in Newport Beach or Manhattan Beach or whatever, right? Like,
Yeah.
Mhm.
There's a reason. Someone's got a reason somewhere, but
And this is so important to understand because sometimes we talk to clients about investing in opportunity zones, and they'll have their financial advisors who, first of all, don't want them to do real estate. But second of all, they use some of these scare tactics to say, wow, don't ever do real estate because those are like really run down, kind of gang infested places. Like you don't want your money to go there. And so it's yeah, sometimes it's a conversation you want to tell them like, well, let's take a look at what ozone's on. And you might be surprised how close
Mhm.
you live to an opportunity zone, and you make a lot of money. So it's really interesting. The perception of opportunity zones sounds like, I'm investing in very scary places, but it's not
Mhm.
always the
Yeah. And I think that's the problem too in, something that I would like to try to reform with financial advisors is helping them understand that while they might not make a commission on it, they might retain a client if they give them, full picture advice. And, diversification is a good thing, especially in today's day and age where we don't know what might happen in one asset class. And I mean, for me, a lot of my faculty don't invest in real estate because they just depend on a 401k. And I'm just like, you guys are so educated and you are so informed on, maybe different aspects of business, but yet you're not understanding what could actually make you the most money and provide the most long term wealth. And so it's something that I've been trying to do and trying to educate even like my colleagues who, PhDs and all of these things on like, invest in real estate. Come on, it's not that hard. Just because your financial advisor is telling you no doesn't mean it's wrong.
Yeah, yeah, and I think it's difficult because for certain financial advisors, they're actually not allowed, right? They're not allowed to advise that you do it, consider selling away. So yeah, it's difficult. I mean, the way it's set up that, but
Yeah,
it is a
for
common
sure.
concern we hear from clients.
Yeah. So let's transition. I know you mentioned 1031s, and so I want to kind of dive into those. And so with 1031s, are you seeing any sort of indication that there could be potential legislation around there? I mean, I think it's probably been one of the longest running codes within the tax code that we've had, but now is probably gaining a lot of popularity and a lot of awareness around it. So, what are you guys' thoughts on 1031s?
yeah, I mean, I'm not hearing anything lately in terms of potential legislation to limit it and make it go away. Obviously, there was a lot of talk under the Biden administration to do that. For many years, they were talking about it, obviously, but never played out. So, with President Trump being a business owner, real estate investor, I don't see that potentially happening. So, yeah, a lot of our clients still utilize it. It's a great tool to have in your toolkit. When you're looking to, maybe that real estate you've had is kind of tapped out on the equity or depreciation, or maybe that market is kind of saturated, and you're like, hey, I still want to invest in real estate, so I want to take my money and reinvest and redeploy it in a better performing asset, and maybe it's a different town, maybe it's a different asset class in the same town, but it's a great way to do it, right? I mean, one way to look at it for people is like, we all played Monopoly, right? You can sell your two greenhouses and exchange that red hotel or something like that, so
Mm-hmm.
and not have to pay tax right now. So it's a great way to kind of not have that that tax drag behind you slowing you down in terms of building your wealth.
What's really interesting is people didn't know that uh, 1031 exchange was limited, in recent years to where now it only applies to real estate. But
Mm-hmm.
previously, you can 1031 exchange other things. Most common example is like a car. Like when you sell a car, you buy another car. When you trade it in, it could be a 1031 exchange. So there has been some limitations, but yeah, I mean, to exclude real estate from it is probably highly unlikely, at least under this administration.
Mm-hmm. Yeah. So I guess the question would be if we anticipate bonus depreciation coming back at 100%, and I guess are they also planning a phased out plan on that like they had previously? Is that kind of what you're seeing?
I haven't read that deep into it yet, so it's I think it was extended beyond this year. So
Yeah, I think currently the draft says 100% through 2029.
yeah, that's what I
Now,
remember.
whether that's a cliff
Yeah.
or it's a phase out, I don't know that I saw mentioning of that
So, if your clients want to take advantage of the bonus depreciation and basically accelerate that, are you seeing that the hold period for a lot of these assets shorten compared to what it maybe had been in the past?
Not really. I mean, people don't typically make buy sell. I mean, people don't typically make sale decisions based on taxes. So, I think generally you're going to hold the real estate as long as it's cash flowing and appreciating. Um, I mean, if you do take advantage of bonus depreciation and, cost segregation, do all that stuff, what typically it means is when you sell, you can have a larger gain, right? Because you've written off as much as possible in the initial years. So that naturally does lead to more 1031 exchanges. So in our office, 1031 exchanges, I don't know what percentage of our clients do it, but the majority of them do. Because typically they don't, when they sell something for a profit, they're not trying to deploy that money into stock market. It's typically like what Matt was saying, the game of Monopoly. I'm going to sell this and buy, sell a couple single families, reinvest with the multifamily.
Yeah. So I want to know more about your investment strategies. And so, what are you seeing on the market as far as either market specific territories that are, ideal to invest in right now, or maybe rental strategies? I know we talked briefly about midterm rentals or short term rentals. Are there any specific asset classes or markets that you're seeing kind of being ideal right now, or things that you're advising your clients on?
I mean, we really are excited about ADUs, all over the US because the housing shortage legislation has made it much easier to do ADUs. And especially in markets, markets like California, New York, where, land is very expensive, the numbers typically pencil out a lot more because the cost of construction without having to buy another piece of land or another property generally makes a whole lot of sense. So for us, but also for a lot of our clients too, we have clients that look specifically for properties where they could potentially do one or two units of ADUs. Again, it's just looking at, okay, here is this deal. How can I make this property the highest and best use? Whether it's adding units, adding doors, or switching up the use of it, right, from long term to short term or just short term to midterm. So, it's you can still make a lot of money in real estate. You just have to be a little bit more intentional about what are all the different investment strategies to, be less lazy, I guess.
Yeah, and to that point, I think with clients looking at, do you convert that long-term rental to a midterm rental or short-term rental? I think the kind of takeaway is that, your short-term rental doesn't have to be in a market that you typically think of has to be short-term rentals, right? It doesn't have to be a mountain town. It doesn't have to be, we've had clients invest in short-term rentals in the lot in Las Vegas area and it's not on the strip. It's 25 minutes away from the strip, right? Where it doesn't add up in your head, right? That doesn't sound reasonable, but it works in the right situations. And people in midterm rentals, like Amanda was saying earlier, right? There's a lot of people being displaced. There's a lot of areas where traveling medical people are coming to areas they have to work for 6 months, and so those are the areas to look for that you may not even heard of that town before, but maybe they got a big medical facility or something like that. We've got clients that syndicate deals that have been sitting on the sidelines for 2 years and kind of just getting back into it, going back into the multifamily space. So that's one that's kind of sounding interesting coming up. So there's a couple that we're seeing.
Yeah. So I know that multifamily has been kind of like on a uprise. A lot of people looking to invest in multifamily. Are you seeing any uptick in other commercial assets, or is it primarily been single and multifamily?
Well, it's really interesting. So, I think, like Matt said, a lot of our clients who have been in multifamily have been um, more quiet in the last couple years. So we're seeing an uptick now because actually a lot of multifamily have not been doing well, and so a lot of clients that who've been on the sideline are now ready to deploy capital into purchasing some of those that are, underwater, right? So grabbing the deals
Or
from the
underperforming, yeah.
underperforming. So I know when talks of tariffs and onshoring that was happening, gosh, like a month ago. A lot of our clients were considering pivoting more into commercial real estate because of, expected demand for jobs and, onshoring, all those kinds of things. Now, obviously, the conversation of tariffs has changed a bit. So not really gotten too much insight into what those specific clients, if they're still looking at commercial spaces or not.
But yeah, on the flip side too, right? Like just even our, Orange County area, you can drive around and see lots of empty office spaces, right? So it's kind of a, I don't think we have a lot more clients doing multifamily, that kind of thing than pure like office space per se. But again, yeah, every market's different, right? So I think if somebody finds a good deal and, there's going to be underperforming office buildings that are going to be available for purchase, so that if that can make sense.
Mhm. I will say self-storage, we have more and more clients getting into self-storage. I think it's an expectation of, a weaker economy, which leads to self-storage businesses performing better. Now, whether that happens
Needing to
or not,
store all your stuff.
right? You're not going to move into it.
I mean, I also see it as an aging population, right? When kids are kind of moving their parents into retirement homes and maybe are hesitant to get rid of the parents' furnishings and other things, they want to just have a storage unit.
Yeah, we were actually just talking with a friend. We spoke at a conference and we were sharing a Uber with a friend who mentioned that they're going all in on um, senior care living facilities. And what's really interesting, speaking of aging population, but what's really interesting is the plan is not to operate assisted care or senior living. It's more of just like acquiring real estate to kind of support all that stuff because the people who maybe a doctor who wants to open up an assisted living might not want to own the real estate or, think about the real estate. So that's an interesting solution to kind of be the real estate provider for people who want to open and operate, um, you know, living solutions for the aging population.
Yeah, I mean, it's a good build to suit and either a land lease or, some sort of
Yeah.
triple net kind of deal. I think that's smart because, like you're saying, we do have this aging population. And while people are living longer, we're still entering the point that that population is going to be tipping and we're going to need a lot more care than what we probably currently have available. And so I think that's a really good market to kind of tap into as well. So, you guys are in California, and California has been one of the places with the highest homeless population that we've seen across the country. And obviously, we haven't seen as much construction on new builds or adding in apartment complexes. What are your thoughts on tax reform to help incentivize low income housing or at least affordable housing to encourage developers to actually go forward with that versus, the traditional maybe mid and luxury style apartment complexes?
That's really interesting because I mean we've seen historically, right, when there are incentives like low income housing tax credits, it entices builders, especially those who work with investors, right, who are syndicating deals, operating funds, incentivizes them because it becomes a little bit easier for them to raise money, right? Most people who invest passively in the syndications are those with high taxes and could benefit from depreciation as well as tax benefits. Now, practically speaking, I mean, for California, I'm not on the builder side, so I don't even know this to be true, but my understanding has been um, there's just been so much legislation that you have to jump through in order to get permits, in order to build, and it's that all that complexity that is what's holding people back from additional construction. And so, from a builder's perspective, I think maybe what they're looking at is, well, it took me so long to get to this point. It's like, what's the highest and best use of ROI for this specific property? And unfortunately, I think for the most part, it's going to be more luxury rather than affordable housing.
Yeah, I think that's a ongoing discussion in the state of California, right? I mean, when we speak at different events across the country, people are we take it for granted that California has the highest state income tax rate, but when you tell people that, hey, some people in California pay 13% of state income taxes, and they're like, their eyes get big, like that's not possible, right? Like that doesn't add up because I pay 2% in my state or whatever, right? So you've got that. I think I read an article or saw a headline that the average person in Southern California has to make like $400,000 to afford a home just in their annual earnings nowadays. And so obviously it would make sense, hypothetically to have low income housing and provide that opportunity. But to Amanda's point, I think there's so many hoops to jump through and um, that it would be a challenge to say the least.
Yeah.
Yeah, for sure. I mean, it's one of those things. I'm on the local planning commission here, so I see what builders and developers have to go through as far as the local legislation and local permit process, and it would deter people from wanting to move forward, especially because you have holding costs that you have these costs that you're going to have to pay regardless of whether you have income coming in or not. Taxes are due and insurance is going to be due, and if you have financing it's going to be due. So I think that that's a good point, that maybe not even at the federal level, but we need to kind of even look down to the local level to figure out what can we do to help simplify this process, or at least allow these developers a way to I don't want to say expedite the process, but at least have maybe some more leniency if they are planning on trying to go forward with specific low income or affordable housing.
Yeah, I know like at the local level when I used to live in Las Vegas, Nevada was really, there was a significant plan to entice businesses to come to Nevada. And with, the state already having no income taxes, to try to sweeten the deal, there was different things they proposed that was like property tax abatement, sales tax, use tax abatement, where it's kind of like, hey, if your business comes here, you meet our criteria, it's completely tax free, no taxes at all at the state and local level. So yeah, there's all sorts of cool things that could be done, but easier said than done, right? When it
Yeah.
comes to politics and all the things that go on behind the scenes.
Yeah, it made me think there's a property down the street from our office that has been vacant for at least 5 years, and they finally put a fence up, tore it down, and now the sign says they're putting up, mid-level townhomes, right? So that's not low. That's not low income. But obviously, I have no idea what happened over the last 5 years. It could have just been that they were waiting to raise investor money, but makes you think
Mhm.
that there's probably a bunch of hoops they had to go through to get permits and get this and that, and it's like, man, this should take a year at most, right? Like, let's get
Right.
this process going.
But what's interesting is once they put the fence up, I mean, to build these mid-rise apartments, it was super fast. It was kind of like nothing
Oh
happened
yeah,
for years.
they're putting utilities in the ground
Yeah,
already. Like it's
like
They're like,
24/7.
we're
Let's do
ready. We're
that.
ready to start
yeah.
making money on this thing. That's great. Okay, so I always like to ask my guests before I start to wrap things up, what books do you recommend new investors or investors looking to expand read, or at least look into?
Oh gosh. Well, I mean, real estate specifically.
It doesn't have to be real estate specific. It can be anything.
Okay, then you can pick one. So anything, kind of a general book. I really, really liked the 4 Hour Work Week. 4 Hour Work Week, I think, is so helpful. I mean, I know it talks about it from sort of from a business perspective, but it really applies to real estate as well. Just in general about how you can leverage other people's time, you can leverage systems to basically get things done faster rather than you doing everything day to day. I think that's one of the common mistakes that people, when they get into real estate, they think they have to do everything. They think they become hands-on landlords, and you don't have to. There are other ways to own real estate and build wealth. And then alternatively, the people who maybe do too much of it themselves, and just in understanding that you can leverage, other people's time, other people's systems to be able to do it. So and still maybe keep your full-time job as well.
I think for me, it's not a new book by any stretch of the imagination, but it kind of got us going on our journey of how do we look at things differently, right? Because you were talking about your colleagues that are, on the older end, and you're banking on that 401k, right? But that book I read years ago was Rich Dad Poor Dad. It just kind of was just a way to think about things differently, approach life differently than what your father or your grandfather taught you 50 years ago or whatever, right? So I think that was pretty eye-opening for me 20 plus years ago.
Yeah, definitely a common thread. I hear that people refer to it as the purple Bible. So that's, but you guys also have written some books too. So can you share what your books are?
Yeah, so we wrote two books. They are obviously tax books, but the first one is the book on tax strategies for the savvy real estate investor. So don't blame us for the long title. That was recommended by our publisher, but
You got to
uh,
be savvy to read it. If you're not a
yeah.
savvy investor, don't read
And
it.
then there's the advanced book, cracking the code for the savvy real estate investor. But we wrote these books kind of. They're we look back. It was like, hey, we've read a lot of tax books, and a lot of times it was written in like tax technical jargon that might be understood by a CPA but boring to the everyday reader. So we kind of wanted we like the idea of writing a book and telling stories that everybody could understand. And so we obviously the chapters are about different topics, but we weave stories in there with client stories to kind of see how it worked for this person, or what did they do wrong, what did I hey crap, I did the same thing that person did, like I don't want to do that again, right? Like, and so we try to make it entertaining and fun, and we've gotten a good response on it, and so people seem to like it, which is awesome. But yeah, it was just a kind of way to share some tax strategies for the everyday investor, and ways that you can utilize that for your real estate.
You can get it on, it's published by Bigger Pockets, but you can get it on Bigger Pockets, Amazon, Barnes and Nobles, anywhere books are sold.
Yeah, and I guess I'll be a a commenter that I've read both of your books. I've listened to the Audible and I've read them and I've highlighted them, and so I loved them. I thought they were great. So I'll definitely be putting them in the show notes so that people can take advantage of that. Do you guys are you guys planning on being speakers at any upcoming conferences that people might be able to come and listen to you?
Yeah, we have so many. We're going to, so one of our clients was one of the original hosts of Bigger Pockets podcast, Brandon Turner. He has an event coming up in Austin at the beginning of
June.
June. What is it called?
Better Life Real Estate Summit from Better Life.
Real Estate
Mhm.
Summit. And then we'll also be at the Bigger Pockets conference this year in Las Vegas in October.
Nice. That's great. Um, any last minute advice that you can give to people who are either looking to start their real estate journey or expand upon their real estate journey?
I think, the main advice would be just to start. Don't get stuck in the analysis paralysis. Don't get stuck in, there's always going to be conversations about why this is not the right time to buy, whether it's real estate or tariffs. But, take a look at the numbers, right? If you are comfortable with the numbers and what they look like in the worst case scenario, then you'll have the confidence to take that step into your first or next deal.
And I would say just surround yourself with mentors that you can lean on and bounce things off of, and um, you don't have to have them all in place before you jump in the deal, obviously, but definitely start building that network of mentors that you can trust and rely upon for good advice.
No, that's great. I love it. Well, Amanda and Matt, it has been so much fun talking with you guys. I was so excited to have you on the show. And that is going to wrap it up for another episode of Inspire Wealth. I'm Prof M, out. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.